Okay, class, you're welcome to another class with equity professionals. My name remains Wasiu, and today we'll be moving on with our financial reporting class. Today we are going to move deep into IAS 16, that if we don't finish it, what we'll have left is just to solve questions. Remember last week we started looking at IAS 16, which is a standard that deals with property, plant, and equipment. And I told you that what we'll be looking at in the standard are the definition of PPE, recognition of PPE, subsequent costs, measurements, derecognition, disclosures, and we'll solve questions. So today, my main focus is to explain all the principles to you relating to this standard, and hopefully we start solving questions today. Next week, Saturday, we're going to round up on this standard. Now, I defined PPE to you last week as any tangible item that is held for use in the production or supply of goods or services, rentals to others, and for administrative purposes, and it is expected to be held for more than one accounting period. I explained this definition, paying maximum attention to the fact that for an item to be PPE, the item must be a tangible item. It must be an item with physical substance, an item that you can see or touch. And this item must be held for use, not held for sale. You must actually be using it within the entity. What are you using it for? Production or supply? You all know what production is. Anything you are producing in your business, that equipment, that item that is facilitating that production is PPE or supply. Any item that you are using to supply your goods or services, that item is PPE because you're using it to supply, or rentals to others. Any item that you owe, that you rent out to others, of course, that means you're going to get that item back. That item is most likely a PPE, and it could be for administrative purposes, which helps your office to run properly, or which facilitates smooth operations of the business environment. We're talking about things like furniture and fittings, your air conditioner, your computer equipment, the fans in the office. All of these items are for administrative purposes. They are fundamentally PPE as well. And any item that fits into this use, you must use it for more than 1 year. If you are using it for less than 1 year, it is not PPE. It must be held for use for more than 1 year. Now, when an item fits into this definition, I told you that before you can record it in your books, it must meet two recognition criteria. And the recognition criteria, number one, is that it must be probable that future economic benefit associated with the item will flow to the entity, meaning that we have to be, to a large extent, be sure that we're going to make money from that asset. In fact, not just making money from the asset, the money that is made from that asset will actually come to us. So it must be probable that future economic benefit associated with the item will flow to the entity. And this simply signifies that you must have control over the asset, and that the risk and reward associated to the asset is with you. That's the first recognition criteria. And two is that it must have a cost that can be measured reliably. It must have a cost that can be measured reliably. If it does not have a cost that can be measured reliably, then you cannot put it in your books. You know that even if you're given an item for free, it doesn't mean it does not have a cost, because you can get its selling price or replacement cost. Then you can get its cost. So if you have an item that you cannot determine its cost reliably, then you cannot put it in your books. You cannot put it in your books. So when you want to put or recognize an item of PPE in your books, that's why you debit PPE and you credit bank, as if you are paying for the item, outrightly. If you are buying it on credit, I say you credit other payables. If you are given for free or a grant, you credit other income. How do you measure an item of PPE? I said when it comes to measurement, we are looking at the monetary value that you're going to attach to this item of PPE that you are recognizing in your books. When it comes to measurement, is either you're talking about initial measurement or subsequent measurement. Initial measurement is the measurement at the date of the transaction, or the measurement at the date you bought the item, or the date of acquisition. Subsequent measurement looks at measurement at the end of the year or the reporting date. For initial measurement, we said an item of PPE is initially measured at costs. And when we are talking about cost, I told you about 4 components of cost. The first component is the purchase price plus import duties plus non-refundable purchase taxes, less trade discounts or rebates. I emphasized on these non-refundable purchase taxes that they are simply VAT. But this VAT shouldn't be a VAT that you can claim the input later. It must be a VAT that you cannot claim it back from FRS. That's what we mean by non-refundable. If it's refundable back to you, then you cannot add that VAT element as part of the cost of your PPE. I also emphasized on trade discounts or rebates. I told you that there is a huge difference between a trade discount and a cash discount. I told you a trade discount is a discount or reduction in price for bulk purchase or for being a first-time customer. And more importantly, a trade discount is a discount or a reduction in price that you get outrightly or immediately. In fact, the reduction is impacted immediately on your invoice that you're expected to pay the net immediately or even later. But cash discount is an early settlement discount. Is a discount that is conditional on payment, that if you don't pay, you won't get it. So for that reason, cash discount is not deducted outrightly from the purchase price, and that is why cash discount is not part. It's not something you would deduct from the determination of your costs. You don't deduct it from your cost because you are not sure whether you get it or not. And I asked somebody told me that I asked that if you eventually get it, how do you treat it? And the person said income. That's a discount receipt. That's perfect. And that was how I explained trade and cash discount to you last week. The second component of cost is the directly attributable cost of bringing the asset to its location and condition for it to be capable of operating in a manner intended by management. And examples of directly attributable costs are initial delivery and handling costs, installation and assembly, professional fees, site preparation costs, employee benefits that are directly attributable to the acquisition of the asset, and pre-production testing costs. We explained all this critically last week. And I told you something fundamental, that the nature of a directly attributable cost is that they are the costs you incur from when you pick up the asset from the supplier's place to when the asset gets to your location and when it is ready for use. All those costs within that ecosystem, all the costs in between that period are directly attributable costs, and they should be added to the cost of the asset. You see, as soon as an asset is ready for use, that you are just the one delaying the usage. It's possible for an asset to be ready for use in January, and you don't use the asset until even after 1 or 2 years. Any cost that you are incurring after that asset is ready for use, those are not directly attributable costs. And I gave you some examples, like cost of opening the facility, or a startup cost or similar pre-production costs. These are costs that are incurred after the asset is ready. I mean, an asset was ready, you now want to do an opening ceremony or do a startup ceremony, or you have to incur some pre-production arrangement before you start actual production. You want to incur some costs, I mean, that are not related to the asset being ready. Or you need to do some advertisement or promotion related to the asset. Or you have to do some relocation costs to relocate some staff that will use the asset. Or you needed to train some staff that you need to use the asset. Not that the asset is not ready, the asset is ready, but they don't know how to use it. That does not affect readiness. It's you that you are not ready. The asset is ready. Or general and administrative expenses. All these are not directly attributable costs. General administrative expenses are like maintenance costs, maybe probably you need to pay some rent, or probably the warehouse, you want to put the assets, you need to do some lighting, general admin. No, those ones are not directly attributable. Or initial operating losses, or probably you have started using the asset and the asset is not operating to capacity and you're making losses. That is not part of your costs. You expense those expenses. You expense those costs, right? And the third one, or the third component of cost, is the commissioning cost, which is the cost of removal, dismantling, and restoring the site on which the asset was located. And this is usually required when there is a law in the country where that business is located, that requires that this asset must be removed. And this is common in the oil and gas industry, and it could exist in some other industry as well, where they are required to restore the site back to the way they met it. Because this is a cost that you cannot avoid, right? So that's why IAS 16 says that before you can even recognize this cost, there must have been a corresponding provision in line with IAS 37. I'll teach you that also. But the reality here today is that when you have to incur this type of costs, it is a future cost. It's not something you're going to incur now. You will incur it in the future, but you know you will incur it. So you need to recognize it as part of your asset today. You cannot recognize future costs today, because that cost you must have estimated is a future cost. In fact, it will have been the initial estimate of the cost of removal and all of that. It's an estimate you can make because you won't be sure how much you will actually incur. So what you put as part of the cost of your assets is the present value of that future cost. You need to discount it to present value. We'll solve questions to show you how to do that discounting very soon. Now, finally, is borrowing costs that are directly attributable to the acquisition and construction of the asset. Of course, if the asset is a qualifying asset, that's when this one will be applicable. Borrowing cost is like interest to pay on borrowing, right? So if you borrow to construct an asset, a qualifying asset is an asset that you have to construct yourself. That's a qualifying asset. Any asset that is not a qualifying asset, that you're not constructing yourself, you would not capitalize the borrowing cost. You will not add the borrowing cost as part of the cost of that asset. It's only qualifying assets that you capitalize the borrowing cost. So when you borrow money to construct an asset, the interest you are paying on that borrowing, that interest should also be added as part of the cost of that asset. That interest will also be added as part of the cost of that asset. When you solve questions, you will see that these are very simple areas of the standard. So those four were what we talked about last week as the component of cost. Now, still under measurement. So when the asset is actually ready, right, all these other costs that I've mentioned, they are what gets the asset ready. Now the asset is ready. That does not cease the incurring of costs. You still continue to incur costs on the asset. And those costs you incur after the asset is ready, we call them subsequent costs. And the popular one you can follow through it will be repairs and maintenance, right? Or maybe you need to do some replacement of parts, or probably you need to do some improvement and upgrade, or probably you need to do some major inspections, and so on and so forth, depending on the type of asset you're talking about. But these are costs subsequent to acquisition. The major thing you need to be able to figure out is this: all these costs you incur after the asset is ready, are you supposed to capitalize them or expense them? When I say capitalize, I mean that, are you supposed to add them to the cost of the asset? Or are you supposed to expense it by putting it to P&L? Now, the standard says that subsequent costs should be capitalized, if they meet the recognition criteria. And you already know the recognition criteria. If they meet this recognition criteria, this year, that it must be probable that future economic benefit associated with the item will flow to the entity, and it must have a cost that can be measured reliably. So that means that, let's say, for example, you incur repairs and maintenance. So you look at that repairs and maintenance, does it meet this? Will that repairs and maintenance generate future economic benefits? Can we measure it reliably? Of course, almost all those costs would be able to meet this second one. But repairs and maintenance, does it generate future economic benefits? If the answer is yes, that means repairs and maintenance should be capitalized. So let me open the class for like, let's say 1 or 2 minutes. Let me hear from you guys. What do you think? If you are not in a noisy environment, you could be able to unmute and talk and interact with me. If you are, just stay muted. So let me hear from you. Repairs and maintenance. You acquired a big generator. After 6 months, you needed to do repairs. You needed to do some maintenance and all of that. Does that bring future economic benefits from the asset? Does that generate future economic benefit? Okay, who's talking?
Good evening, sir. This is Lukman. Good evening.
Okay.
From my own understanding,
okay,
repair and maintenance can come as an expense and can also come in form of being capitalized. Just like we said, if the generator set is being maintained like normal servicing of the general part of the gen, it can be overlooked as repair and maintenance. But if it involves like changing the coil of the generator, which is going to bring future benefit and it's going to last over years, I think that cost can be capitalized. That's my own
so if you're
understanding.
not changing the coil, look, man, we should not capitalize it.
What I'm saying is, if we are changing the coil, which is one of the important part of the gen, it will be capitalized. But if it is just normal servicing of the gen, like just the routine servicing, that can be expense.
Okay, so that one does not generate future economic benefit.
Yes.
Abby?
Yes.
Okay, thank you, Lukman. Go ahead, Olalere. You wanted to say something?
Yes, sir. Good evening, sir.
Hi, Olalere.
Okay, so for me, repairs and maintenance is actually in 2 ways. It can be an expense and also be capitalized in the sense that, for example, now let's use Nestle as an example. they are manufacturing a site where they manufacture a million and all. They have machines. So if the generator they are using to power the machine, if there is no light, if it's faulty, they will definitely need to do some repairs and maintenance and all, so that if there is no light, they can use it to power the generator, they can use it to power the machines. So at that point, the repairs and maintenance for that generator, you can capitalize it. Let's now look at our own personal, like our personal home. Some of us have generator. Any repairs and maintenance done on that generator will just be an expense. So that's what I understand about it, sir.
Nice one, Alalere. Very good reasoning. Okay, and good one from you also, Lukman. Okay, okay. So let me come in now. So, repairs and maintenance, popularly in reporting, we expense it. Any item you will describe as repairs and maintenance is we expense it. We don't even look at it twice. In fact, anytime we have to do changing of major parts, we don't call it repairs and maintenance anymore. We'll simply call it another name, like replacement of parts, because most often those ones are capitalized. And why do accountants generally expense repairs and maintenance? Because we believe that machines should be maintained. Machines, there are some requirements. In fact, when you buy it, they will tell you that you need to service it every 6 months. You need to change the oil every 3 months. You need to do this. And they will tell you that if you don't do it, you see that 5 years life that this asset is supposed to use, you will not use it. You will not use it. It's just like you bought a car that's supposed to take you for 10 years and you're not servicing it. Within the next 2 or 3 years, the engine will knock and the asset will not be able to get to its predetermined useful life. So repairs and maintenance is it doesn't generate any additional benefit. What it does is just to ensure that the benefit that the original cost was supposed to give to you, it gives it to you. So that's why we usually expense repairs and maintenance. And in this context, when we say that a cost generates future economic benefit, it means that it must add, it must increase, it must improve the existing economic benefit in the sense that if you buy a car and the car is supposed to spend 5 years ordinarily, what repairs and maintenance does for you is to ensure it spends 5 years. But when we say a cost, a subsequent cost generate economic benefit, it means that that cost must be capable of improving the life of the asset by an extra, say, 1 year or 2 years. It must improve the productive capacity of the item. It must improve the useful life of the item. And that's what items like replacement of parts will do. Items or cost like improvement and upgrades will do. And items like major inspections will do. They can significantly upgrade or improve the useful life of the asset or improve the productive capacity of the asset. That a machinery that can do 1,000 units before, that when you incur this cost we are talking about, it will improve the productive capacity of the asset to 1,200 units. That is what we mean by a cost being able to generate future economic benefit. We are talking about additional future economic benefit. So the key thing, the meaning of this recognition criteria in the context of subsequent cost is that the cost must be capable of improving the productive capacity of the assets or the useful life of the asset. If you can do this, then of course you should capitalize such cost. Your exams are always straightforward, right? In the exam, examiner will be very clear that, okay, we bought an asset in 2001. During 2002, we incurred 100 million. And because of this additional 100 million we incurred on this asset, the useful life of the asset increased by 2 years. They will now say you should account for that additional 100 million. Should you capitalize it or should you expense it? I mean, if you remember this principle, that means that should be capitalized because it has improved, it has increased the useful life of the asset. The useful life of the asset. I want to believe that is very clear. Now, the next thing I'm going to is subsequent measurements. That's the next principle. I'm still coming to sub questions on all of this, but I just want to clear the principles first. That's because that's the most important thing in financial reporting. Principles. You need to know these principles so very well. So well that solving question is the least thing you worry about, because when you understand the principle, the question will come easy for you. Now, subsequent measurements is measurement at the end of the year or measurements at the reporting date. So in reporting, we usually get the value of our assets in our books. That is subsequent measurement. And when it comes to an item of PPE, the subsequent measurements are two. There are two subsequent measurements. We have the cost model, and we also have the revaluation model. The cost model, this is used to determine the carrying amount of an asset. I'm just mentioning this for the first time, but I'm sure most of you will know something we call book value. Let me call it NBV, net book value. It's the same thing as carrying amount, or sometimes they call it carrying value. Cost model is a formula that is used to determine this carrying amount of an asset or net book value of an item of PP. And it is determined as below. It is determined as below. Number one is the cost of the assets minus accumulated depreciation on that asset minus accumulated impairment losses. So when you do this cost minus accumulated depreciation minus accumulated impairment losses, do you know what it gives to you? It gives you the carrying amount of these assets. You see, that's why they call this cost model. You will see that is actually a formula. And basically, when I say that subsequent measurements, we mean the value of the asset at the end of the year. And the value of an asset at the end of the year, or to be specific, a PPE, that value, we call it carrying amount. I want you to get used to either carrying amount or carrying value. And there are two ways of determining this carrying amount or carrying value. It's either you use cost model or evaluation model. I'm still on cost model. And cost model is simply your costs minus accumulated depreciation minus accumulated impairment losses. Now, see, each of these items, since this is a formula, where do you get this one from? Where do you get this one from? Where do you get this one from? So the costs is actually gotten from the initial measurement. If you remember initial measurements, the initial measurement that is determined at cost. By the time you determine your initial measurement at the date when the asset is ready for use, that is where you will get your cost. And in fact, this is usually the asset account, because asset account is always at cost when you are using cost model. That initial cost is always in your asset account. So when you buy a machinery, when you buy a generator, when you buy any asset you can think about, what you would always find in that asset account is the cost of that asset. That's the only thing that goes there. So when you want to determine the value of an asset at the end of the year, the value of an asset at the end of the year is not just that cost in the asset account. No, it's not. I mean, from what you're learning now, that's not the value of the asset at the end of the year. It's just part of the formula. Now, so this formula, the cost, you get it from the asset account. This accumulated depreciation, I will teach you about I haven't taught you depreciation. Of course, that's the next thing I will teach you now. So you get this one from the accumulated depreciation account. So this one is a separate account from an accumulated depreciation account. I will tell you how this account is derived, how it is giving birth to, and all of that. Then the third item is accumulated impairment losses. I'm not going to teach you in this standard impairment losses. I'll be teaching you probably in the next, before the end of the month, we should do impairment IAS 36. So it's a separate standard dealing with this, but there will be an account called accumulated impairment losses account where this is determined. So if you're learning something today, what I really need you to remember and never forget, even though some of you already think this way, and it's very difficult to get this off your mind, and I hope you will be able to. I hope you will listen and be flexible. See, some people think that this carrying amount is determined from the asset account. And most people think that is what it is. And most accountants think so, but it is not. You're a professional student. You need to understand clearly that carrying amount is not determined from an asset account at all. This carrying amount is determined using a model, a formula. And in fact, you see, this thing I've just shown you, there's something we call fixed asset schedule. It's always in the notes to the accounts. It's always in the notes to the account. That is where we usually do this computation. What you will find in the asset account is just the cost of the asset. Only the cost of the asset. Nothing more. For you to get the value of an asset, you will need a fixed asset schedule where you would pick up the cost from the asset account, remove accumulated depreciation, remove accumulated impairment losses to determine carrying amount. I hope that is gotten. Before I go deep into this one, because I've already explained this, I will just need to explain this depreciation. Let me quickly show you the second model that helps in determining our carrying amount. Okay, this model is also used to determine carrying amount. And the way this works is as below. This one use fair value, or let me call it revalued amount, minus subsequent accumulated depreciation minus accumulated impairment losses. This gives us carrying amount of this asset. Now, for revaluation model, you will see that instead of costs, what we do is a fair value or revalued amount, which will also be found in the asset account. So revaluation model is usually used when you choose to revalue your asset periodically. Then you have a situation of fair value or revalued amount. Minus subsequent accumulated depreciation accounts, which will also find in your accumulated depreciation account. You will see that it's different from this one that was just accumulated depreciation. This one is subsequent accumulated depreciation. When I get to evaluation very soon today, I will explain that critically. And of course, accumulated impairment loss account, which is found in an accumulated impairment loss account. Again, this carrying amount is not determined in your asset account. No, it is determined from a fixed asset schedule, just like I've explained up there. It's determined from a fixed asset schedule. And this is exactly what you do in that fixed asset schedule. You just do this. Of course, we will still solve a few questions from that respect. Okay. This is subsequent measurement. These are the two models. I kind of asked questions around this before that explain the cost model and the evaluation model. No need for big English. Cost model is just a way of determining your carrying amount, and you don't even have to see that. Just tell them cost model is cost minus accumulated depreciation minus accumulated impairment losses. Revaluation model is fair value or revalued amount minus subsequent accumulated depreciation minus accumulated impairment losses. You will get your 3 or 4 marks. Okay, now I'm sure every one of you understands that. Still under subsequent measurement, since you already know costs, you know what cost is. Let me teach you accumulated depreciation. I'm going to be silent around this impairment losses because as soon as you can determine costs and you already understand accumulated depreciation, that means you understand subsequent measurement because you would be able to get carrying amount. So let me just explain this depreciation. When I'm done explaining this depreciation, then I will then explain this revalued amount. Okay, then we'll be done. Okay, so please just give me 1 minute. Give me 1 minute. Now, let me go to depreciation. Now, the first thing I need to tell you very clearly here, the first thing I need to tell you very clearly is that depreciation is not loss in the value of an asset, or is not a way to provide for replacement of an asset, or it doesn't show that an asset is losing value. Please take that away from your mind first, because that's what most people think depreciation is. You are accountants. That is not depreciation. So when we say depreciate, it doesn't mean reduction in value. That's not what depreciation means. That's not, as far as accounting is concerned, that is not what it means. So take that away from your mind. Then what is depreciation? According to IAS 16, depreciation is the systematic allocation of the cost or depreciable amount of an asset over its estimated useful life. So depreciation is the systematic allocation of the costs or depreciable amount of an asset over its estimated useful life. So there are three things here from what I can see from this definition of depreciation. The first thing here is systematic allocation. The second is cost or depreciable amount of an asset. And the third is estimated useful life. You see, from this definition, it's very clear that what we are trying to do with depreciation is to do an allocation, but not just allocating anyhow, a systematic one. I'm still coming back to that systematic allocation. Let me start with what we are allocating. We say that we are allocating the costs or the carrying amount of an asset. I say carrying amount, depreciable amount of an asset. That is what you want to allocate, meaning that you already know the cost of an asset, the amount you bought the asset, the one I explained to you under initial measurement, or the depreciable amount of an asset. So they are not the same. Depreciable amount and cost are not the same. In fact, depreciable amount is actually cost of an asset minus residual value of that asset. That's depreciable amount. In fact, from this depreciation, since depreciation is all about allocation, Abi, so when we say depreciable amount, it means the portion of the cost that you can allocate. Look at it. Since depreciation is saying it is allocation of the cost or depreciable amount. Okay, so depreciable amount is like amount that is depreciable or amount that is allocatable. And the amount that you usually allocate ordinarily should be the cost. We are saying that there is a portion of this cost that you cannot allocate, which is the residual value. You can't allocate it. You can't share it. It's a residual value. So when there is a residual value and you remove that from the cost, we say, don't let us continue to call the remaining value cost. Let's call it depreciable amount. If there is no residual value, everything is cost. But if there is residual value and you remove that from the cost, you say, let's call the remaining depreciable amount. And why are we removing this residual value? Why can't we allocate or depreciate this residual value? It's simple. It's because residual value is a scrap value. Residual value is a value at the end of the useful life of the asset. Is a scrap value, is a value at the end of the useful life of the asset. Is a value that is determined when you can no longer use the asset. Is a value that you determine when you want to sell off the asset. Residual value. And you know that depreciation, the aim is to allocate over useful life. So residual value, in fact, there is no remaining useful life for the asset anymore, as far as residual value is concerned. So if that kind of value exists, called residual value, we say you take it away from the cost. So now let's know the one we can what? Depreciate. Let's know the one we can what? Allocate. Now, I really need to mention this about residual value. Residual value has to be determined from day one because depreciation has to be determined from year one, how you allocate. So, and this residual value, like I said, is a value determined at the end of the useful life of the asset, is the scrap value of the asset. And if you have to determine it from year one, that means there's no way there is no objective way that you can determine that figure. It's highly subjective, meaning you make an estimate. So to determine residual value, you estimate it. That goes to show that because anytime we make estimates in accounting, we expect you to ensure that that estimate makes sense in order to reduce the level of measurement uncertainty. I'm sure you remember measurement uncertainty when I was teaching you faithful representation, right? So you have to ensure that there is a basis for that estimate to reduce the level of measurement uncertainty. And also because of that, residual value is something you would revise almost every year because it's an estimate. It's an estimate. That is not where we are going. To determine depreciable amount is straightforward. It's simply cost minus residual value. Meaning depreciable amount is the amount that is allocatable. Now, before I go to this, how you allocate, right? Let me also mention this estimated, because this cost or depreciable amount, you need to allocate it over the estimated useful life of that asset. And when I say estimated useful life, you see, it can easily go for the number of years the item or the asset would be productive. It's like the productive life of the asset. That's the number of years of the assets, or that the assets will exist. And it can also be the productive units that can be obtained from the asset. So when we say useful life, it's not all about number of years. Useful life can also be the number of units, or it could even be the service hours, right? That is useful life of an asset. So don't be surprised when you see a question giving you useful life as units or giving you useful life as hours. Don't be surprised. It means useful life. So, and it could easily be given as number of years as well. I've seen an ICANN question before. They asked you that, how do you determine the estimated useful life of an item of PPE? There was a question like that before, like 2 or 3 diets ago, I think for 4 or 5 marks. Because useful life also is estimated. It's not something you know with certainty. You have to estimate it. So when you're doing your estimate, what will be the basis of determining that estimate? Or what will ultimately determine the useful life of that asset? Number one will be the useful life of a similar asset. The useful life of a similar asset. If you have a similar asset that you have been using for so many years, and you now bought that type of asset again, you can use that as a basis for determining the useful life of these new assets. Number two, the existence of a legal limit on the use of the asset. If the asset has a legal limit where you only have access to the asset for 5 years or 7 years or 8 years, if there's any legal restriction on the asset on how long you can use it, of course, as far as you are concerned, That's the useful life of the asset for you. Number 3, another thing that will determine the useful life is the maintenance culture of the entity. An asset that is well maintained would have a longer useful life compared to the one that is not properly maintained. Another one can be the quality of the asset. This can also determine the useful life of the asset, and many more, and many more. So finally, is systematic allocation. That's the third item here. Since depreciation is all about allocation of the cost or depreciable amount over its useful life, what is then this systematic allocation? It's just an English word. It simply means spreading. You want to spread something. You want to share something, right? And this systematic allocation, the whole idea is coming from the idea of accounting that I think I taught you something under conceptual framework. I taught you about accrual accounting, accrual basis of accounting. I taught you that 2 weeks ago. And that is how we record financial information in reporting, which means that in reporting, when, for example, when you pay rent, when you pay 5 years rent, for example, now, you pay 5 years rent. You know, when you want to record that rent in your books, you will not record that 5 years rent as an expense in your book all at once in that year 1. The way you will have done it is that you will record only the year 1 rent, the remaining 4 years rent, that would be capitalized and placed as a prepayment, as an asset. So you would only record just 1 year rent. So in year 2, you would put the second year rent also as expense. So that's the concept of accrual accounting. Accounting is about what have we spent this year? I mean, what are we enjoying this year? What are we using this year? And that is why when you buy an asset, like I'm teaching you now, PPE, and this asset, you know you are going to use it for 5 years. You don't expect to recognize the cost of that asset all at once as an expense in your P&L. And that is why we usually have assets. That's why, in fact, that's what we call assets in reporting. Is a present economic resource controlled by an entity as a result of past events. And is something that will generate future economic benefit to you. So when you have a cost that you have incurred, when you have an item that will generate benefit for you in the future, that is what we call an asset. So as you are getting that benefit, so year 1 passes, that portion of benefit, yes, you have an income, but that asset, a portion of it will go to expense. You expense it because you have gotten the benefit from that one. In fact, there are 2 concepts to that. There is accrual concept that say only expense item relating to year 1 alone, in year 1. Only item relating to year 2 alone in year 2. And the second one is there's something we call matching concept. So matching concept is different from accrual concept. Matching concept is saying that every year you must match income with expense. You must match income with expense. So in accounting, we do a lot of systematic allocation. Is a way of accrual accounting that we said anytime we spend money, anytime you buy anything, and that item is supposed to be used for more than 1 year, we will not put the whole of the item costs as expense this year. You will not expense it. In fact, we'll go and we'll put it as assets. So as we are now using the item, we will now be expensing it gradually each year. So that if we are supposed to enjoy the benefit for 5 years, after 5 years, you will have allocated the costs. You will have what? Allocated the cost. And that's the whole idea of depreciation. Depreciation is just the portion of the cost of an item of PPE that you have used for that year. That I bought an asset for 100 million and I'm supposed to use it for 5 years. I cannot possibly put the whole of the 100 million in my P&L as an expense. So what I will do, I will put it as an asset, 100 million. As year 1 goes by, I know that, okay, I've enjoyed benefit from this asset from year 1. I will expense 20 million, put it in P&L. I will call it depreciation. In year 2, as soon as I use the asset in year 2 alone, another 20 million. I call it depreciation. Year 3, year 4, year 5. After year 5, I will have allocated the cost of that asset over its estimated useful life. So if you have an asset that you bought for 100 million, and you know that at the end of its useful life, this asset will still have a value of 10 million. It means that you will not be able to allocate the entire 100 million. What you can allocate is only 90 million. So you would also systematically allocate that 90 million over 5 years. That's how it works. That's the whole idea of depreciation. So, like I've mentioned, that depreciation is not reduction in the value. That's not what it means. Depreciation is just a systematic allocation of the cost of an item of PPE. And this allocation, it actually follows through with accrual concepts and matching concepts. So now, how do we then allocate? There are 2 methods of allocation recommended in the standard. 2 methods of allocation recommended in the standard. There is the straight line method of allocation, straight line method, and there is the reducing balance method. You see, for the straight line method, this one is used when you want to spread the cost or depreciable amount of that asset equally, where the entity wants to spread the costs or depreciable amount of the assets equally over its what? Over its useful life. Or where the assets generate equal amount of economic benefits each year. That's where you would likely use this method. Either where the entity wants to spread the cost, they just want to spread it. It's just a decision now. Okay, we just want to make this easy for ourselves, which is what most companies does anyway. They will just say, okay, let's do it over 5 years. They will just share that cost over 5 years, or they share it over 10 years, whatever it is they want to do. However, the right way is actually this. to look at the pattern of economic benefits from the asset. If it's an asset that is generating equal amount of benefits every year, then you should use straight line method. And when you are using straight line method, in order to ensure that you get the same amount of depreciation that you put to P&L every year, all you simply do is the costs minus that residual value that gives you depreciable amount. You just divide it by the estimated useful life. This, whatever you get, is your depreciation every year. Whatever you get here, that's your depreciation in year 1, in year 2, in year 3. It will be equal. But you see this reducing balance method. This reducing balance method is used where the assets generate higher amounts of economic benefits in its earlier years and lower amounts of economic benefits in its later years. That's where you use reducing balance method. From the name reducing balance, in the sense that the depreciation will reduce as the year goes by. Depreciation reduces as the year goes by. So, and the way you would determine depreciation per annum in that wise is simply by getting a depreciation rate. You see us using a depreciation rate, either 20%, 25%, which will be applied on the carrying amount of the asset. They can also use depreciation rates when you're using straight line method also. So this one, you could also use depreciation rate, but in order to give you the same amount of benefit every year, it will be applied on the costs or depreciable amounts. That's for straight line method. It will be applied on the cost or depreciable amount, while this one will be applied on carrying amount. When you apply it on carrying amount, it makes the depreciation you get to be reducing every year. So you will not get equal amount of depreciation like you will get in this instance. You will not get the same amount of depreciation that you will get in this instance. Now, when you determine your depreciation every year, how do you pass it in your books? What's the double entry for depreciation for each year? Let me open the floor a little bit. Let me just hear your voice for 1 or 2 minutes. Who can tell us what's the double entry for depreciation?
Okay, good evening, sir.
Hi, Michael.
Yes, sir. So we debit our depreciation account and then we credit our asset account.
Okay. Okay. Any other trial? Depreciation account and asset account?
Yeah, I think the right word is accumulated depreciation account.
Thank you, Lukman. Thank you very much. This is the correct one. You debit depreciation account and you credit accumulated depreciation account. Okay, so what Michael said is what most people think, which is what I corrected first when I started teaching you this. They would think that this accumulated depreciation, it impacts the asset account. So some people think you get carrying amount from your asset account. That was the first thing I corrected. And that is what is reflecting in what Michael said. Some people think depreciation is this one, depreciation account that goes to your POL, then you now credit the asset account. No, you don't credit asset account with depreciation. Asset account is always at cost. Is always at cost or at fair value, depending on the model you're using. So it goes to an accumulated depreciation account. So if you have a scenario like this, let's say you bought an asset and the asset is, let's say, 150,000, and the useful life of the asset is, let's say, 10 years. Let's say 10 years. So if they ask you to calculate depreciation in year one, depreciation will simply be the cost, Abi, divided by 10 years, right? And that gives you how much? 15,000 as your depreciation. That means that 15,000 goes to P&L, as you call it depreciation, while the other leg goes to accumulated depreciation, which means that in your P&L statement, you have under your administrative expenses or as a separate line item. Me, when I'm preparing audited account for my client, I put depreciation and amortization as a separate line. I don't even lump it up as part of admin in practice. So you have depreciation as a separate line in your P&L. In your statement of financial position, right? You will have prepared a schedule, a fixed asset schedule, where you have your costs. Your cost is how much? 150,000. From your accumulated depreciation, you have a balance of how much? 15,000. Then what will be your carrying amount? Your carrying amount is how much?
135.
135.
135.
So may I remind you that this one is usually done in the notes. We call it is a fixed asset schedule. So what goes to this place is that PPE at your, we call it, is the carrying amount that will come here. At how much? 135,000 in year one. So in year two now, how will it look like? In year two, in your statement of profit or loss statement, in year two, your depreciation will still remain how much for year two? Who can tell me?
15,000, sir.
Thank you. 15,000. In your statement of financial position for year two, under your notes, first, you will also prepare a fixed asset schedule. What will be the cost of the assets? Remains how much?
150.
What's now your accumulated depreciation now?
30,000.
20.
How much?
Yeah, that's 15 plus 15, that's 30.
Thank
30,000.
you. Thank you. It's now 30,000 now. What's now your carrying amount?
120,000.
That's 120.
Where does it go?
That's a
Statement of
PPR.
financial
Statement of
position.
financial.
Statement.
As how much? 120. So that's how you continue to do it. That's the whole idea. So you see that what I'm doing in these notes is what I call cost model. Cost model. So, and that's what we call subsequent measurement. It's done at the end of the year. It helps you get your carrying amount that you put in your asset account, while also remembering that this depreciation that comes to P&L account, every year you are allocating 15, 15, 15, 15, 15, 15. So over 10 years, your carrying amount becomes what? Zero. at the 10th year, meaning that you have depreciation has fulfilled its aim. You have followed strictly accrual accounting. Now, if you have something like this, if the examiner gives you cost to be 500,000, they give you accumulated depreciation to be 80,000. They give you residual value to be 25,000. They now give you depreciation rates to be 20%. They now say calculate depreciation for the current year using straight line method and reducing balance method. So let's start with straight line method now. Using straight line method, our depreciation is calculated as what? Depreciation is calculated as
Cost
cost
minus
minus
residual value
mm-hmm,
divided by number of years. Or
divided by what? Number of years.
number of years.
Useful life.
Estimated useful life.
Now, in this case, what's the cost of this asset?
500,000,
What's the residual value?
25,000.
25,000.
What's the useful life?
We were given rate.
So what do we do?
That will be
So
5 years.
we multiply whatever we get from 500,000 minus 25 by the rate.
Good. So, person that say 5 years, yes, that's logical. That is right. Okay, I won't say you are wrong, but don't bother converting it to rate, to number of years. You can just use it directly. So you can just use whatever you get from here, just like he has said, multiply by what? By 20%. And I actually showed you when I was doing this one, when I was using this straight line method. I said it could also be depreciation rate multiplied by cost or depreciable amount, which is what is showing here. Depreciation rate multiplied by depreciable amount. So what would this give us? Can you press your calculator?
95,000, sir.
95,000. Now, in our SOPL, we are going to have depreciation as how much?
95,000.
5,000.
In our SOFP, first, of course, in the notes, we'll do a fixed asset schedule. We'll have costs. How much is the cost? 500,000.
500,000.
What is now the accumulated depreciation?
95,000.
Plus
No.
80,000. That's 175.
Exactly. Thank you very much,
Okay.
Dami. 95,000 plus
80,000.
80,000.
80,000.
That's 175.
That's 175,000. So that means our carrying amount is how much?
Minus 500.
How much is the carrying amount?
325,000.
So it goes to our SOFP, 325,000. Now, using reducing balance method, What will be our depreciation? I told you your depreciation is simply the depreciation rate multiplied by what?
The
Who can
carrying
remember?
amount.
Carrying amount.
Carry amount.
Thank you. Carrying amount. In this case, what's my depreciation rate? It's 20%.
20%.
From this question, what is the carrying amount?
325,000.
From this
420.
question,
Okay, carrying amount, that's 120.
420. That's correct.
120.
No, 120K.
420.
Okay, carrying amount.
Minus
500
80.
minus 80,000,
Yes.
which is this 500 minus what? Accumulated
80,000.
depreciation. 80,000. That gives me my carrying amount. So what do we have? What's 20% of 420?
Nice.
84.
84,000.
84,000.
You see, all these things I'm showing you is exactly how you find these questions in the exam. This is what the examiner cares about. How to calculate depreciation using reducing balance method, different from using straight line. And to know what goes to P&L and what goes to statement of financial position, and to present your notes properly. We don't joke with this. This is what you need in reporting class. Let me give you one more example before I go to evaluation. Of course, we are still going to solve plenty questions around this area. This is just me explaining the principles to you. This is just me explaining the principles. So let's say the question gave us cost to be 250,000. They gave us residual value to be, let's say they give us, let's say 40K. They now give us useful life. They give us 5,000 units. They now said that in year one, the asset can produce 2,000 units. In year two, can produce 1,500 units. In year three, can produce another 1,500 units. Now has to calculate depreciation. I don't know. So the peculiarity to this one is that, let me erase this red thing on my board. The peculiarity to this one is that the examiner actually gave us the useful life in units. They gave us the useful life in units. And you will find that in your exams too. They give you the useful life in units. It now says that in year one, 2,000 units. In year two, 1,500 units. In year three, 1,500 units. You're now asked to calculate depreciation per annum. Right? So how do we do this? In fact, what method can you use? Can this one work with? Is it the straight line? Is it the reducing balance? Which method? So what I know for sure is this. Depreciation is a systematic allocation of the cost or depreciable amount of an asset. I know that formula clearly. Because I know that formula clearly, I know that all I'm doing is just to spread or allocate the cost or depreciable amount. But now, since I'm given residual value, I know that I will need to get depreciable amount, which is cost minus residual value. And the cost in this context is 250,000 minus what? Minus 40,000. And this is 210,000. So depreciation per annum in year one, since I'm depreciating over the useful life of these assets, and in this case, the useful life is 5,000, right? So I will do 210,000. If I do divided by 5,000 units, this will give me the cost per unit. But in year one, this company did 1,000 units. In year one, this company did how many units?
2,000.
1,000 units. Oh, 2,000 units. So I multiply by what? 2,000. So this will give me the cost of 2,000 units. It gives me the cost of 2,000 units. Can you press your calculator and give me my figure?
84,000.
Sorry, just wanted to remove something. 84,000. The same thing. This is year one. The same thing in year two. My depreciation will be 210 divided by 5,000 units. This gives me the cost per unit. How many units did I produce in year two?
1,000.
1,000.
1,500 units. So what do I have?
63,000.
63,000. My year three depreciation, 210 divided by 5,000 units multiplied by 1,500 units should give me the same 63,000 naira. You can find this in your exam, and this is how you solve this scenario. These examples I've given you are so important. They are so important that you will continue to see it in your face every time. Every time you look at past questions, you see it there. You really need to understand them. When you are given useful life in units, you must be able to do this. Get the depreciable amount. You know that you are allocating based on units that you are given each year. First, you do the depreciable amount divided by the total units. That gives the cost per unit, multiplied by the unit produced for that year. You do that for each of the years. In fact, there was a diet. There was a diet. There was a diet. The way I can ask it is, they gave you the useful life in units. They now say that after 1 year, the company incur the costs and improved the units from 5,000 to 8,000. It improved the units from 5,000 to 8,000. There are two things involved there. Number one, that cost that was incurred after 1 year is a subsequent cost that should be capitalized because it has improved the useful life of the asset. Number two, another implication is this. If they give you a question like that here, they now said in year two, they incur the cost that instead of 5,000 units, they now say the new useful life now is now 8,000 units. In fact, to make it simple, let me see, let's say they say is now 8,000. No, let me do 6,000. I know what I'm doing. They say it's now 6,000 units from year two. They incur the cost that the total useful life is now 6,000 units. Year one is gone. You have done your depreciation for year one. But for year two and year three, your calculation will change. Cannot divide by 5,000 units anymore. What do you now use now? You can tell me?
6,000.
That's correct. 6,000. You multiply it by what? You multiply it by what? Anybody?
You still multiply by the 1,500 units produced.
No. You can't multiply by 1,500 units produced. Reason is that if the useful life increased to 6,000 units from year two, don't you think that also means that the unit produced in each year would also improve?
Mm.
That means it will improve because look at it. The useful life before was 5,000. In year one, this guy was able to do 2,000, Abi. What should the remaining useful life should be how many units?
3,000.
It's
3,000.
3,000. But now they are saying it has now improved to 6,000, meaning that it has doubled. Abi,
Yes.
Yes.
has doubled. So it is, I mean, it just makes sense to assume that year two will double. Year three will double. So year two, we expect that this guy, it means that he will do 3,000 in year two, 3,000 in year three. And that's what that 6,000 will mean. So that means in year two, this becomes 3,000. This becomes 3,000. Why this is working with 6,000. Okay. This I'm just discussing with you was actually a live past question. The examiner believed it should be easy for you. Just how many marks? Was it for 8 marks? It was a complete question. We'll see it. It's part of the question we'll solve very soon. Okay, so that's that scenario. Let me just remove this one so that when you're, I will still share this thing with you, so it makes sense. Okay, so those are the depreciation methods, and that's all about depreciation for you here. Do we have any question before I go to revaluation, revalued amount, or let me call it revaluation? Any question? We still have like 25 minutes to go. Today now, it's almost 10 minutes into my time because you people did not join this class early enough. You're joining 7:10, 7 something. Our class starts 7, and as soon as it's 7 o'clock, I'll start because I have so much to cover and I don't have time to be waiting for anybody.
I have a question.
Okay, Ibrahim.
Excuse me.
Ibrahim,
I have
okay.
a question. So
Okay.
you mentioned that an amount was spent on the asset to increase the unit produced.
Yeah.
Will the amount be added to the cost and consider the unit as well in the calculation of depreciation?
Yes, it will. It will be added.
Okay.
Yes, it will be added.
Thank you.
You're welcome. Okay. Remember this. Looking at revaluation, remember this. I told you that there is a model in subsequent measurement called revaluation model, and is fair value or revalued amount minus subsequent accumulated depreciation minus accumulated impairment losses gives us carrying amount. So that is that's a revaluation model. So I've already explained depreciation to you. I left out impairment losses. When you calculate your depreciation either using straight line method or reducing balance method, ultimately in your fixed asset schedule, in the notes to the account, you would remove this from this amount. You have seen where you remove it from the cost. But for revaluation, is not cost anymore. Is what you find in your asset account is usually the fair value or revalued amount of the asset. So this is usually done anytime during the year, right? And this choice of revaluation model is usually used by organizations or entity that want to make sure that the value of their assets is similar to its market value or its realistic value. They want the value of their asset to be very similar to that. So they choose evaluation model, even though they will spend more money, because that means they will have to get a valuer to help them determine this fair value or this revalued amount. And in some cases, if the value of the asset is highly volatile, they would have to even be doing this fair value every year. They will be paying valuers every year. If the value of the asset is less volatile, it's not a value that changes frequently like that, maybe periodically, maybe every 5 years, or every 3 years, or every 7 years, depending on the judgment of management. So it's periodic. And may I mention that when you choose a revaluation model for a class of assets, let's say you have a building, you now decided to choose a valuation model in your subsequent measurement for that. If you have more than one buildings within that organization, you must use that same evaluation model for all those buildings. You cannot use evaluation model for one building and use cost model for another building. The choice of this model is on a class by class basis. Is on a class by class basis. So that means that you can use evaluation model for all your land and buildings while you use cost model for your motor vehicles. That is fine. In as much as you're using the same model for all assets in the same class. When an entity uses revaluation model, which goes to show that they would have to get the market value or the fair value of that asset, it then means that there would always be changes in value of that asset at a point in time. So at the date when that evaluation is determined, there would either be something we call a revaluation surplus or a revaluation deficit. So the first thing I need to talk about is how do you then address this? Because when you have to do revaluation at a certain date in time or any time you have to do it, it will always give rise to either of this. And if it's a revaluation surplus, this means that when you got your new value of your assets, let's call that fair value or revalued amount, or your fair value. When you got this value, it was higher than the value of the asset at the end of the year, which you find in your statement of financial position or your fixed asset schedule, which is your carrying amount. When you have that market value being higher than the carrying amount, it means you have a surplus. But if the reverse is the case, you have a deficit. So revaluation surplus is where the fair value is higher than the carrying amount. Now, when you have this scenario, this is an income to the organization. It is an income to the organization. But this type of income is not an income that you can recognize in profit or loss, because it's a volatile income. It's an income that can even become a loss in the near future. Conceptual framework says that you put such income in the other comprehensive income. You put it in the other comprehensive income, which you would eventually transfer to your revaluation reserve. You put it as a reserve because it's an unearned income. You have not earned it. You can only earn this type of income when you actually sell these assets at that increased amount. But for now, you have not earned it. You leave it in the other comprehensive income. That goes to show that when you make a revaluation surplus, yes, the value of the asset has increased. So you most likely are going to debit your assets, right? You will debit the assets with that increase, but what you're crediting is your a revaluation surplus account, right? But this revaluation surplus account, will take it to OCI. You're going to take it to OCI. You take it to OCI. However, if there is a previous revaluation deficit on the same assets, in this case, you can record the revaluation surplus to POL, to profit or loss, to the extent of that deficit. We are saying that ordinarily, revaluation surplus should be recognized to OCI because it is an unrealized income. It should be a reserve. Keep it first, don't share it, keep it. But we are saying that if there was a previous evaluation deficit on the same asset, because I will tell you very soon that because evaluation deficit is a loss, we would usually recognize it in P&L. So if we had a previous evaluation deficit on the same assets, that means that If you now make a surplus in subsequent years, then you can go ahead and put that surplus in P&L in such a way that if in 2002 we had a deficit of 100,000 revaluation deficit, 100,000 as revaluation deficit, and in 2003 we now have 120,000 as revaluation surplus. What we are saying here is this. In this case, in 2003, in your P&L, this 120, you will take 100,000 of it to P&L to net off against the previous deficit in such a way that the only amount that goes to OCI as evaluation surplus will just be 20,000. That's how evaluation surplus and deficit works. If not for this previous revaluation deficit in 2002, if there was not deficit in 2002, that we just made a surplus in 2003, you know that the whole of this 120 will have gone to OCI. But because there was a previous deficit of 100,000, for that reason, we would have to net off that deficit first by taking an amount to the extent of that deficit to P&L. In this case, is 100,000. So out of this 120, we are saying that net of 100,000 of it against the previous deficit. Then the remaining 20,000 can go to OCI. For evaluation deficits, this usually occur where the carrying amount in this case is higher than the revalued amount or fair value. So we have a revaluation deficit. When you have a revaluation deficit is a loss and should be recognized to P&L immediately. It goes to P&L because it's a loss. But if there was a previous evaluation surplus on the same asset, then that deficit can then go to OCI to the extent of that surplus, to net off that surplus. Then any excess can then go to P&L. Saying that if in 2002, I have a 230,000 revaluation surplus, and in 2003, I now made a revaluation deficit of 300,000. In this case now, in 2003, in my OCI first, I'll go and net off, out of this 300,000, I'll net off 230. It's like debiting the deficit. Debiting your OCI. Not even the deficit. You are debiting your OCI to net off that surplus in OCI. Then the remaining goes to P&L of 70,000 as your deficit. So this is how revaluation surplus and deficit work. So anytime we have revaluation, At the date when you do your evaluation, the first thing you will need to deal with is evaluation deficit and surplus at that date of evaluation. And this is how you compute it, comparing that revalued amount against your carrying amount. If it is a surplus, surplus goes to OCI. If it is a loss, loss goes to POL. But even when you have a surplus and there is a previous evaluation deficit on the same assets, in this case, that surplus would have to go to P&L to the extent of the deficit. And when you have a deficit, and in previous period we had a evaluation surplus, that deficit has to go to OCI to the extent of that surplus. Any excess that can then go to P&L. Give you three scenarios. Scenario one, if you have cost of an asset of 150,000 and you have accumulated depreciation on that same asset of 30,000, and you then revalue the assets, so you have a revalued amount of 170,000. If you want to account for this, you see, at the date of revaluation, the first thing you need to do is, let me put, if I want to analyze this analysis, you need to determine either you are having a revaluation surplus or what? Or deficit. And you do that by comparing your revalued amounts. How much is your revalued amount? 70,000 with your carrying amount. How much is our carrying amount? You can unmute to tell me how much is our carrying amount?
120.
120.
That's
Thank you.
perfectly correct. Perfectly correct. So mistakes that some students will make is when calculating evaluation surplus or deficit, you see them comparing revalued amounts with costs. No, that's wrong. You compare revalued amounts with carrying amount. In this case now, I am having a revaluation surplus because the value of my asset has increased by almost 50,000. By 50,000. Now, this 50,000 will simply go to where? OCI. Abi? We'll go to OCI. So, assignment one that I'm giving you, determine the journal entry of the revaluation surplus. I would really appreciate every one of you do this. If you don't do it, then we'll start having issues in this class. It becomes a challenge for us because you're going to slow us down next week. This is your assignment one today. All the previous assignment I've given you, you have not done it, not even 1%. So you really have to do this and send it to me before our next class. My assignment is determine the evaluation surplus here. Now, scenario two. If you have cost of an asset of 230,000 and the accumulated depreciation of the same assets was 45,000 and there was a previous previous evaluation surplus on these assets of, let's say, 30,000. We now have our revalued amount. Let's say our revalued amount is now 180,000. In this case, if you want to analyze this, you will need to determine our revaluation surplus, or what? Or deficit. To do that, you compare our revalued amount. How much is it? 180,000 with our carrying amount. How much is our carrying amount in this case?
185,000.
185,000. What do we have? Evaluation surplus or deficit?
Deficit of 5,000.
We will have a evaluation deficit of 5,000. In this case, this deficit, where will it go to? P or L or OCI?
P&L.
It will be
It will go
recognized to where?
To P&L.
it will go to
Hello?
OCI to the extent possible.
No.
We have a surplus of 30,000 earlier. So we take off the 5,000 from it. So our evaluation balance will be 25,000.
That's correct. This evaluation deficit goes to OCI. It goes to OCI because there was a previous evaluation surplus. It goes to OCI. If you understand this, congratulations. That means assignment 2 is determine the journal entry for the revaluation deficits. May I ask you, are you going to do this assignment or you will not do it?
We are going to do it, sir.
We are attempting,
We
sir.
are going to do it, sir.
Okay.
Tempted, sir.
I can see that. I can see 2 people in their mind, or even 3 people that I know they will not do it. I know Semiat will not do it. I know that Lukman will not do it. And also Oreoluwa will not do it. Am I correct?
I'll do
Why?
it, sir.
I will do it.
Okay. So I would have loved to just do it for you, but I mean, it will be fun if you can actually attempt it yourself. And next week, we start with that, with the corrections to this one. Then we end up with other analysis and start solving questions. So the whole of this week, we'll start solving questions on starting from that initial measurement. We'll go to solving questions on depreciation. We'll go to solving questions on revaluation, disposal. We'll go to past questions. I don't even mind spending the whole of next week solving questions, even both Saturday and Sunday. We're just solving questions, because I promise you this topic is everything. This is the very foundation of reporting. You'll be meeting everywhere. You'll be seeing it everywhere. This PP, it forms the foundation of everything that we're going to teach you. So I don't mind the next class, we spend the whole of it solving questions. The upper one, then we can smoothly and easily go to the next topic. But let's see how it goes. I'm going to stop here for tonight. Do have a wonderful night. I'll catch you guys next weekend. Bye for now.
Thank you, sir.
Thank you very much.
Thank you, sir.
Thank you, sir.
Appreciate.
Thank you, sir.
Yeah, so while everybody is leaving, I think Dami wanted to ask a question. Dami, you can go ahead.
Sorry, sir. I wanted to ask if we are going to open all necessary journal entry, or is it just for the surplus or the?
Open everything. Let's be like that. But what I actually want is the surplus. That is what I want. But everything. Let me just see the best you can do.
Okay.
Yes, please.
Thank you, sir.
You're welcome.